Hello, my people. Okay, welcome back to this another episode of Elliott Wave analysis. The basic lessons of Elliott Wave analysis is always that we have impulsive wave and then a corrective wave. That is 1 through 5, something like. Which probably I believe that most of you know that this is always just the basic lesson. That is one, we have 1, 2, 3, 4, 5, and then we have A, B, C, and ABC. That is the corrective wave structure. But then that is just the basic aspect of it. Something I came to learn later when I started out on trading Elliott Wave strategies is there is more to it than just knowing the basic aspect, that is wave 1, counting wave 1 through 5, and then wave A, B, and C. That is the corrective wave. The more to it aspect that I came to learn later, that is that you can be counting the Elliott wave, but then you are counting Elliott wave in a wrong way, or rather you are not really considering the aspect of market structure into Elliott wave analysis. So this is what I have to show you, because again, another most important lesson that I came to learn later is most of you guys, most of us Elliott Wave enthusiasts, we tend to just think that so long as you know how to count 1 through 5, you will just tell where wave 5 is going to be, or wave 4 is going to be, or wave 3 or wave 1. But then these things don't just happen out of nowhere. These things follow, these rules follow the dynamic of market, that is the market sentiment, because Elliott Wave trading is psychological. Elliott Wave trading is psychological. So if you look at an example of what I have for you today, and before we look at that, if you haven't yet subscribed to this great space, kindly do so. Subscribe to this great space, turn on your notification bell on, so that anytime I post a great update, you don't get to miss out. So today we are looking at NZD Swiss. So on looking at NZD Swiss, I want to show you the aspect of trading, the right way of trading Elliott Wave analysis. That is when we will be incorporating it into Elliott, into this currency pair, that is NZD Swiss. Again, this is a live market, so you get the benefit of foretelling. If you happen to watch it early in advance, you can get the benefit of foretelling where the market will be going, or where the market will be headed to. At the same time, if you are going to watch it maybe later on, it is still a benefit, because you will now use the same knowledge to tackle other markets that maybe you'll be looking at that particular time. So as you can see, when I talk of Elliott Wave, I talk of market trend. That is the most important thing you need to incorporate, the trend of the market. So this market has been in a downtrend for a very long time. It has been in a downtrend. This is a daily time frame. If you narrow down, if you zoom out to weekly time frame, you will realize that this market has been in a prolonged downtrend. So our analysis, we are still looking at it in terms of a bearish, but then that is not the end of it. You cannot just say you are looking at it in terms of a bearish and that is the end of it. So looking at this currency pair, I have wave 1 through 5, and the most important question that most of you might be asking, or might be wondering, or rather must be questioning yourselves is how do we tell, how can you tell where wave 5 was, or wave 3 was, or the nitty-gritty part of it. So that is what we want to talk about. So if you look at this currency, I'm considering this as wave 1, wave 2, wave 3, wave 4, and then finally wave 5. And I want to tell you the reason as to why I'm considering these waves as stated. So this is the most important aspect. Where we are headed to, or rather what I want to show you, is the most important. So this is wave 1, which you know, wave 1 is beginning of is the first wave of the impulsive wave. And wave 2, this becomes wave 2 because wave 2 cannot cross, or rather cannot trade past 100% of wave 1. So this is a perfect wave 2. Wave 3, how can you tell that this is a wave 3? How can you tell that this is a wave 3? Considering the fact that maybe you might be thinking, this is a past market, or rather this is a hindsight. The best way you can tell that this is a wave 3 is wave 3 is always 200%, 161, 200% of wave of the first wave. 161 or 200% of the first wave. So you could just ensure that at least wave 3 falls within that region. So if you take your extension, fib extension, you will see that wave 3 actually surpassed. We saw wave 3 being supported right at this point, but then it broke that point and traded around 200%. 200%. If you look at this, it is 200% of wave 1. So 200% fib extension of wave 1, that's a perfect area for wave 3. So after wave 3, what you know very well that we have is the correction, that is a triangle. This triangle always you cannot have your triangle trade in wave 2. Rarely you will have a triangle in wave 2. Triangles, they always form around wave 4. The reason as to why triangles form around wave 4 is because of the activity that has happened right in wave 3. So most of these participants, they will be taking on positions around wave 4. That is why we have a triangle in wave 4. Triangle can also be a consolidation. You can also, another name of a correction is consolidation. So around consolidations, a market tends to take out positions, and some scalpers also, they tend to get into positions with the trend, that is getting into sell positions, but it will take time. So that is the reason as to why this triangle will always form around wave 4. At the same time, triangles can form, corrective triangles can form in wave B. So if not wave 4, then they can only form around wave B. So that is the rule. That is the rule. If you're watching this, count yourself a very lucky fellow. So after wave 4, the most important question is, how do you know where wave 5 is going to fall? Where wave 5 is going to fall? And that is what I am answering you. Wave 5, the first rule of wave 5 is it can always be equal to wave 1. Wave 5 can always be equal to wave 1. So wave 5 can be equal to wave 1, but as you can see, this is not the case. Another way you can tell about wave 5 is wave 5 will always be 38% of wave 1 through 3, or 61% of wave 1 through 3. So how you measure that is as simple as this. So we have 100. We have 61%. That is 61% of wave 1 through 3. So if you have this 61% right at this point, you will see that market is trading around this area. So this becomes a perfect wave 5. This becomes a perfect wave 5. So after this perfect wave 1 through 5, the question is what next? After wave 1 through 5, the basic aspect is market will form a correction. The correction being ABC. The reason as to why the correction is ABC, that is just to coin the aspect of a correction after wave 1 through 5. But then it is not a must that we have wave A, B, and C. So after wave 5, we are seeing a good pattern forming right around this point, and that pattern is a correction, a triangle. So after wave 5, we can have again a triangle, but on a large scale. So this becomes our triangle, and this is what we want to trade. Oh, sorry. So this becomes our triangle, that is after wave 1 through 5. After wave 1 through 5. So this becomes the triangle. Again, the rules of this triangle is very simple. The rules of this triangle is very, very simple. The rule is this triangle can surpass market might trade past this wave, that is past the line, just as in this case. But then what you need to ensure is that this market doesn't cross or doesn't trade above point C. So long as market doesn't trade above point C, this still stands out as a valid setup. So let's say market trades around this area, and you see market come and break wave D, we will continue with that trend. But in another case, or rather in another scenario where market trades above point C, then that definitely means you are supposed to change the dynamic, or rather the perspective of this market will have changed. This means this means at point C, this is an invalidated. This above point C, it is an invalidated setup. So this is the aspect of Elliott Wave analysis and the correction, and how to tackle and how to catch a good wave. With Elliott Wave analysis. So again, the most important thing is the right way of trading this triangle is you need to ensure, first of all, you need to ensure that market breaks point D. So this becomes a good correction. So your duty, or your job, is just to be patient, to wait for market to break or to trade below point BD. If market breaks below point BD, then what you need to ensure is you need to just be prepared to initiate sell positions to continue with the trend. So this is what I have for you today. Precisely, if you need exact entry points, that is something I give to my VIP students. Any more lessons on Elliott Wave analysis, you can just contact me so that we have a one-on-one session to see, or rather to take you through Elliott Wave analysis and the right way to trade Elliott Wave analysis. This has been an accumulated knowledge for the past 6 years of trading Elliott Wave analysis. So if you have any question, just comment down below. If it's something I can be able to answer you, I'll answer you. But most of the important, or rather most of very heavy questions I answer in my VIP group. So if you need to join my VIP group, you can just comment, you can just hit me up, DM me, and we will take it on from that point. Otherwise, see you in the next episode, and have a successful week ahead. Thank you.